What if I told you that America's second largest creditor is quietly walking away from the table? That China, once the biggest buyer of American debt, has been dumping United States Treasury bonds for 9 straight months, slashing its holdings to the lowest level since 2008? And here is the part that should really make you pay attention. While Beijing is selling, someone else is buying. Actually, many someones. But who are they? And what does it mean for your wallet, your savings, and the future of the global economy? If you are watching this and you have not hit that subscribe button yet, now is the time. This is the kind of information that affects every single one of you, whether you realize it or not. So do me a favor, smash that like button, subscribe to the channel, and share this video with someone who needs to understand what is really happening with American finances. Trust me, you are going to want to stick around for this one. Let me paint you a picture. It is early 2026, and the United States national debt has just crossed $38.6 trillion. That is trillion with a T. To put that in perspective, the debt is now increasing by about $8 billion every single day. That is $334 million per hour, or roughly $93,000 every second. By the time you finish watching this video, America will have added millions more to its debt pile. Now here is where things get really interesting. China used to be the biggest foreign holder of American debt. At its peak back in 2013, Beijing held over $1.3 trillion in United States Treasury securities. Fast forward to today, and that number has dropped to around $683 billion. That is nearly half. Gone. Sold off. But wait, it gets even more dramatic. Over the past year alone, from November 2024 to November 2025, China shed $86 billion in Treasury bonds. That is an 11% annual decline, continuing a multi-year reduction that shows no signs of slowing down. In fact, China has now fallen to third place among foreign Treasury holders, behind Japan and the United Kingdom. Third place. For a country that was once America's biggest creditor, that is a massive shift. So what is Beijing doing with all that money? Here is the answer, and it is one that should make every American sit up and pay attention. Gold. China is buying gold like there is no tomorrow. The Chinese central bank has been on a gold buying spree for 15 consecutive months, bringing its total reserves to a record 2,308 tons of gold. That is valued at over $300 billion. While America drowns in paper debt, China is stacking real, tangible assets. And China is not alone. The entire BRICS bloc, that is Brazil, Russia, India, China, and South Africa, along with their new members, is collectively holding over 6,000 tons of gold. These nations have been purchasing more than 1,000 tons of gold annually from 2022 through 2024, marking the longest such buying streak in modern history. Russia leads with 2,336 tons, followed closely by China with 2,298 tons and India with 880 tons. But it goes even deeper than just gold. Brazil just made its first major gold purchase since 2021, adding 16 tons to its reserves. The BRICS nations are not just diversifying their assets, they are building an entirely parallel financial infrastructure. They have created the New Development Bank as an alternative to the World Bank. They are developing BRICS Pay, a digital cross-border payment system designed to bypass Western-controlled financial networks. And they are increasingly settling trade in local currencies rather than dollars. In 2023, China-Russia trade was conducted almost entirely in yuan or rubles, with close to 90% of transactions avoiding the dollar altogether. India is doing most of its energy trade with Russia in rupees or rubles. Bangladesh recently paid Russia for a nuclear power plant in yuan. These are not isolated incidents. This is a coordinated shift away from dollar dependence. Now, let me ask you something. Why would these countries be selling American debt and buying gold instead? The answer is a word you are going to hear a lot in the coming years: de-dollarization. These nations are actively trying to reduce their dependence on the United States dollar for international trade. They are building alternative payment systems, conducting trade in local currencies, and positioning gold as a foundation for a new monetary order. The freezing of roughly $300 billion in Russian foreign exchange reserves after the Ukraine conflict was a wake-up call for every nation that holds American assets. If the United States can freeze Russian money with a snap of its fingers, what is stopping them from doing the same to any other country? Physical gold stored domestically cannot be frozen by foreign governments. It is a sanctions-resistant foundation for international trade. But here is the thing, and this is where the story takes a surprising turn. Despite China selling, despite the BRICS nations diversifying away from the dollar, total foreign holdings of United States Treasury securities have actually risen to a record $9.4 trillion. Let me say that again. $9.4 trillion. A record high. So who is buying all this American debt if China is selling? The answer might surprise you. The United Kingdom led all countries in Treasury purchases over the past year, adding nearly $122 billion to its holdings, a 16% annual increase. That brings British holdings to around $888 billion. Belgium came in second with $119.7 billion in purchases, a whopping 33% increase. And Japan, despite some recent concerns about its own economic challenges, added $115.5 billion to its Treasury holdings. Together, these three countries, the UK, Belgium, and Japan, accounted for the lion's share of foreign buying. Canada and Norway rounded out the top five buyers with $99.8 billion and $56.3 billion respectively. Combined, these five nations were responsible for roughly 65% of the $786 billion in total foreign purchases. Now, I need to give you some important context here. When we talk about Belgium's dramatic increase, it is not quite what it seems. Brussels is home to Euroclear, a major clearinghouse that holds bonds on behalf of investors across Europe. So Belgium's numbers actually reflect where the debt is held, not necessarily who ultimately purchased it. The same logic applies to financial hubs like the UK, the Cayman Islands, and Luxembourg. These are custodial centers where hedge funds and institutional investors park their assets. But here is what is truly fascinating. The higher yields on United States Treasury securities are making them very attractive to foreign buyers right now. When the Federal Reserve raised interest rates aggressively to combat inflation, Treasury bonds started paying much better returns than bonds from many other countries. For Japanese investors, who spent years dealing with near-zero interest rates at home, American bonds yielding 4 or 5% looked like a gold mine. Think about it from a Japanese investor's perspective. For decades, Japan was the country that invented ZIRP, the zero interest rate policy. Japanese banks and insurance companies were starving for yield. When American treasuries started paying significantly more than Japanese government bonds, the math became obvious. Japanese entities now hold about $1.2 trillion in United States Treasury securities, making Japan the largest foreign holder of American debt. But it is not all smooth sailing. Here is where things get complicated. The United States is now spending over $1 trillion per year just on interest payments for its debt. Let me repeat that because it is absolutely crucial. $1 trillion a year. That is the fastest growing category in the federal budget. Over the next decade, those interest costs are projected to balloon to $14 trillion. The ratings agencies have taken notice. The United States no longer has a top credit rating at any of the three major ratings agencies, with 2 downgrades occurring in 2025 alone. When America has to pay more to borrow money, that cost ripples through the entire economy. Higher mortgage rates, higher car loan rates, higher credit card interest. Everything becomes more expensive. Now, let us talk about what some analysts are calling the elephant in the room. Could China weaponize its Treasury holdings? This is a question that keeps some policymakers up at night. The short answer is it is complicated. If China dumped all its Treasury bonds at once, it would certainly cause chaos in American bond markets. Yields would spike, meaning the cost of borrowing would skyrocket. Mortgage rates would jump. The stock market would likely tank. It would be economic warfare. But here is the catch. Selling Treasuries too quickly would hurt China too. A rapid sell-off would drive down the value of the remaining bonds, meaning China would incur losses on its own investments. Plus, selling Treasuries means converting dollars back into yuan, which would cause the Chinese currency to appreciate. That is the precise opposite of what Beijing wants, especially when they are trying to stimulate their domestic economy and cushion the blow from tariffs. As one analyst put it, China selling down Treasuries would effectively be shooting themselves in the foot. The relationship between America and its creditors is mutually assured destruction. Both sides hold the gun, but neither can pull the trigger without getting hit by the ricochet. Still, the gradual sell-off we are seeing is a clear signal. Beijing is reducing its financial dependence on the United States. They are diversifying, hedging their bets, and preparing for a world where the dollar might not be quite so dominant. And speaking of dollar dominance, let us address the bigger picture. The United States dollar's share of global foreign exchange reserves has fallen to around 56%, its lowest level in roughly 30 years. Back at the turn of the century, that number was over 70%. While the dollar still far surpasses all other currencies, including the euro at 20% and the Chinese yuan at a mere 2%, the trend is clear. Central banks around the world are slowly diversifying away from dollar assets. But do not panic just yet. Despite all the headlines about de-dollarization, the dollar remains the backbone of global finance. It is used in 88% of all foreign exchange transactions. It is still the dominant currency for trade invoicing. There is no viable alternative that can match the depth, liquidity, and stability of American financial markets. The euro is fragmented across multiple countries with different fiscal policies. The yuan is not freely convertible and comes with capital controls that make it unattractive for reserve managers. And gold, while a great store of value, cannot be used to pay for shipments of oil or semiconductors. So where does this leave us? Here is my take, and I want you to really think about this. We are witnessing a slow-motion transformation of the global financial system. China is not abandoning American debt overnight, but it is strategically reducing its exposure. The BRICS nations are building alternative payment systems and accumulating gold. The dollar's share of global reserves is declining, even if slowly. At the same time, traditional allies like Japan and the United Kingdom are stepping up to fill the gap. The higher yields on American treasuries are attracting buyers who need returns in a low-yield world. Foreign holdings have actually hit a record high, even as China sells. The real question is whether this can continue. America is adding debt at an unprecedented pace. Interest payments are eating up a growing share of the federal budget. The political will to address the deficit seems non-existent, with neither party seriously tackling the issue. Let me give you some numbers that will blow your mind. The national debt now equals about $113,000 per person in America. Per household, we are talking about $285,000. And here is the kicker. Over the last 10 years, the government spent $4 trillion just on interest payments. Over the next 10 years, that number is projected to explode to $14 trillion. We are not paying down debt. We are paying interest on interest, trapped in a cycle that gets harder to escape with every passing year. The deficit, which is how much more the government spends and it takes in each year, was $1.78 trillion in fiscal year 2025. That is about 6% of the entire economy. The Congressional Budget Office projects that federal debt held by the public will grow far beyond any previously recorded level over the next 30 years. We are in uncharted territory. The Committee for a Responsible Federal Budget has warned that if the national debt continues to grow faster than the economy, the country could ultimately experience a financial crisis, an inflation crisis, an austerity crisis, a currency crisis, a default crisis, or some combination of all of these. They are not saying this will happen tomorrow, but they are saying the trajectory is unsustainable. Meanwhile, gold has been on a historic tear, surpassing $4,000 per ounce in late 2025. Central banks are accumulating the yellow metal at record rates. Countries that once dismissed gold as a relic are now treating it as insurance against an uncertain future. The world is hedging against America, not because they think the United States will collapse tomorrow, but because they are no longer sure it will remain the unquestioned center of the financial universe forever. And that brings me back to where we started. China is dumping United States debt. Japan and the UK are buying. Gold is soaring. The dollar's dominance is being questioned. The debt clock keeps ticking higher. What does this mean for you? It means you need to pay attention. The decisions being made in Beijing, Tokyo, London, and Washington will affect your purchasing power, your retirement savings, your mortgage rates, and your cost of living. This is not abstract economics. This is your life. The financial world is changing. The question is whether America can adapt or whether we are watching the slow erosion of an empire built on debt and trust. Only time will tell. If you found this video valuable, please hit that like button. It really helps the channel grow. Subscribe if you have not already, and turn on notifications so you never miss an important update. Share this video with friends and family who need to understand what is happening with American finances. I want to know what you think. Is China's sell-off a warning sign, or just smart portfolio management? Is the dollar's dominance secure, or slowly slipping away? Drop your thoughts in the comments below. I read every single one. Thank you for watching. Thank you for being part of this community, and I will see you in the next video. Stay informed, stay skeptical, and never stop asking questions.